So welcome everyone to our federal budget impact on SMSFs. My name is Dunn and Tim, our SMSF Technical and Education Manager, joins me. Welcome, Tim.
Welcome, Aaron. Good to be joining you for today.
Yeah, thank you. So Tuesday night, we weren't sure. We were kind of bracing ourselves for a bit of a long night. So we were still, I guess, having conversations at probably 11 o'clock, but not 2 or 3 that we may have been at some periods in the past, but it certainly wasn't 8 o'clock either. So, half an hour after the event. So today is all about getting you up to speed with what the government announced in the budget. And by announcing in the budget, Tim, of course, we're saying it wasn't necessarily just on budget night. We have
Correct.
seen some of these measures really take shape in the first half of this calendar year. So as is always the way, we include our disclaimer for you to note that the context in which we provide this information to you is based upon our understanding at this point in time. So as most of you will be well aware, it was a budget that had superannuation in some areas quite clearly in the gun. So I use this context of a not so super budget. And again, many of you were aware that a lot of the narrative of these changes with superannuation actually fed into mainstream media much earlier than budget week. And this is a very deliberate tactic. And Tim, we see this a lot over the journey whereby they'll kind of test and measure what things are, what the appetite is for things. We saw maybe it's a $5 million cap, maybe it's a hard cap. And ultimately, I think we ended up with a bit of a bushfire on a lot of those discussion points where the government needed to respond, which is why we saw those better targeted super concessions, i.e. the $3 million thing, come out much earlier than we'd probably anticipated.
Yeah, and look, I think you're spot on there, and my memory recall is, of course, going back to the pre-2007 budget when none of us saw any of that coming, and I think at 7 o'clock at night that night, many of us had some form of heart failure as we had to spend the next 12 hours digesting hundreds of pages of reform. So it's not uncommon now for a lot of these measures to be released in that sort of February through to May period. Just so we can be prepared for it.
Yeah, and to some extent, we'll kind of touch on this as we work through. There was a lot of discussion, obviously, with some budget repair that needs to occur. And whilst we did have a surplus, there is some budget repair moving forward that needs to be considered. And therefore, superannuation is that political football that enables an ongoing sort of tinkering around different policy settings. And ultimately, we didn't see as much as what we might have thought, but there is arguably a bit of a reason there, and we'll touch on that as we work into today's session. And I guess from that point of view, some of the reason why ultimately we didn't see the change that maybe we were expecting in totality is because we have not yet seen this finalisation of the objective of super. So we know back in January of this year, the government did put out for consultation this intent to legislate an objective of superannuation, providing a framework in which superannuation policy would be led into the future. And a lot of this was, and if you remember or can recall a lot of the discussion about this as well, is that we did see the government say, once we have bedded down this objective of super, then we will start to look at making the changes that we seem necessary once the terminology has been, in essence, set in stone, whether that was within the SIS Act or as a separate piece of legislation. Now, Tim, they kind of jumped the gun a bit, didn't they, when it came to the $3 million threshold thing. But what we have seen since consultation closed is ultimately not much. And their plan of attack was, of course, to get all this wrapped up in the first half of 2023. So at this point in time, there is somewhat of an argument to say that some of the additional measures that might be in the gun, and we'll touch on some of those towards the end of today's session, would suggest that we might see those evolve once the objective of super is actually bedded down. But as we said there are some exceptions, of course, and we'll touch on those, and in particular, those better targeted superannuation concessions. So it is important to preface, I guess, the budget announcements with this, because when we think about what this objective of super is looking to do, the definition has had broad support through the submissions that we've seen across the various associations, whether it's within the SMSF industry, through ASFA, through the Financial Services Council. So there are some, I guess, adjustments around the edges. So whether we look at the preservation of savings, is it linked to an individual savings or savings more generally? Is it about delivering income, or is it about delivering outcomes? Those sort of things. But ultimately, the concepts of preservation, that it is for retirement, the fact that it is to deliver income or outcomes for the benefit of the individual, that provides a dignified retirement, that is supported by not only age pension, but Commonwealth rent assistance and other things. And ultimately, this equity and sustainability concept, and that goes to the very heart of the $3 million threshold. And it also goes to the fact that the government has other competing challenges within the budget that they need to weigh up and look at the concessions to be able to support things like NDIS and so forth as well. So the clock is ticking here. If you want to find out a little bit more about that, we've included the consultation there as well. Tim, anything else you want to add on that before we get stuck into the budget announcements?
Oh, look, I think all I'd add really there, Aaron, is that perhaps, to coin a term about it is we might expect some form of mini super budget, in the future. But again, one of the quirks of governments is, no superannuation changes in this election cycle, and then that's changed to no major changes. So will we start to see, new definitions of the words major and minor as a result of once they finally legislate the objective? So yeah, it's a bit of a wait and see, but certainly we hope they stick to this time frame of having something sooner rather than later.
Absolutely. All right, so let's get stuck into the budget announcements. And Tim, I'm going to get you to kick off with the first part, which is this better targeted super concessions. Most people obviously have a base understanding. You will have a better understanding than most because you recently were involved in the Treasury consultation within the SMSF sector. So you can potentially provide some further insight into the discussions that have happened before the budget and potentially where they're heading to from there. So I'm going to hand over to you to talk through where we are at with these better targeted super concessions.
Thanks very much, Aaron. And look, yeah, I was involved with the SMSF Association and some consultancy with Treasury, and it takes me back to when they talk about terms that are used in meetings and terms like "we'll take that back to government" often mean thanks, we've written it down, but you'll never see this suggestion again. But there's a few areas that obviously we want to be mindful of. But look, a lot of us understand, and a lot of us have been sort of, I guess, broadly introduced to this targeted superannuation concession over the last couple of months. But through the release of, I guess, media releases, then fact sheets, and then consultation, the terms or the calculations have been broadly changed or I guess expanded upon throughout that process, and more so, some of them have not been expanded upon. So it leaves people like yourself and myself, Aaron, where we'll go out on a limb and put some calculations out as to how we think they're going to operate, and then we'll have some interesting conversations with our industry peers about things, and it leads to I guess a lot of good, healthy debate that then helps us challenge Treasury in regards to these matters. But what we appreciate is that from 2025-26 year, there is going to be this additional 15% earnings tax for individuals who have a total superannuation balance of greater than $3 million at the end of the financial year. Now, I guess one of the key issues for me is that this tax only applies, as it says there, to the proportion of earnings corresponding to the balance. So we see a lot of media around this talking about a headline tax of 30% on earnings above $3 million, but that's because to really try and define it for what it is actually quite complex, because you are paying, yes, an additional 15% tax, or paying up to 15% tax on the proportion of the earnings over and above that $3 million. So it simplifies it. It overly simplifies it to say that people will be paying 30% tax. Because in a broader sense, there's a lot more to it when you factor in exempt current pension income and the like. So, it in its current format, whether we like it or not, leaning towards not there, it is based on total superannuation balance, and then there will be sort of commensurate treatment of defined benefit pensions, defined benefit interests, and the proof will be in the pudding as to what that is. If it's something along the lines that they had for transfer balance cap, where you had a factor to multiply income by to get total super balance and other things, all to be determined. So
Tim, one of the things that we did see then in the budget, so we were wondering whether post that consultation period, which we can see there is quite small, was the fact that the government had indicated in its first full year, we would have about $2 billion of savings. Yep. So the budget papers have in essence confirmed that the budget savings in its first full year would be $2.3 million. Yep. Now that little bit extra has probably incorporated some of the defined benefit interest information. So therefore, the fact that we haven't really seen any change, and your comment before was very pertinent around that, we'll take that back to government and see how that goes, suggests that things like unrealised gains are actually still included at this point in time.
Correct. And I note too that in their post submission that the SMSF Association have again come out this week and said, look, based on the fact that you've ultimately made this announcement now in budget, now is the time to open the consultation period again, because as we allude to there, 2.5 weeks, which incorporated Easter, was really not a sufficient sort of time frame for industry to and that's incorporating all industry and superannuation to be able to provide sort of adequate feedback.
Detail. Yep.
Yeah.
So let's go through this process in a bit of detail.
Yeah, look, and so I think what's worthwhile pointing out here is that there's ultimately or it is ultimately a 3 calculation process, albeit that calculation 1 will determine whether or not you need to progress to calculation 2 and 3. So the first calculation, which is this whole, I guess, the most controversial of the lot at the moment, but this whole concept of determining what somebody's earnings are, is a concept based on our total superannuation balance in the current financial year, plus withdrawals, and we'll talk about withdrawals shortly, and subtracting our net contributions, because the concept here being that most people that are linked to this higher tax will not be making non-concessional contributions. So the whole net contributions is recognising that most will be concessional contributions, and then yes, there's obviously things like CGT cap contributions and downsizer as well, but largely we're talking about taxable contributions there. So we've got that current year calculation, and then we subtract away our total superannuation balance from the previous financial year, and that gives us effectively how much has our fund grown from the start of the year to the end of the year, and we are going to treat that as the earnings basis. So as I said, that is the most controversial part of this announcement, is recognising that it doesn't matter how you got there. The earnings is based purely on a start versus end balance to work out what your growth is. So that's the first calculation. Once we've worked that out, and assuming that's positive, and in a moment, Aaron, I'll get you to go through an example of if you make a loss. Yeah. But once we have determined that those earnings are positive, then we have to work out the proportion of those earnings that is really subject to your amount above that $3 million. So they're saying, you didn't just earn this because you've, all these earnings aren't earnings above 3 million. They're based on the fact that you had everything from $1 up to $3 million. And so they want to work out the proportion. So again, they take your total super balance for the current year, they subtract the 3 million being our base number there, divide that by our total super balance for the current financial year, and that will give you a proportion of your earnings that will be taxable. And then you apply the tax liability, which is the earnings worked out under calculation 1 times 15% times that proportion of earnings determined by calculation number 2. So, there's a bit to go through, and that's going to largely be done by the ATO. So we can expect, a lot of engagement with the ATO again through this process, and the importance of reporting information on time to ensure that the ATO can record things appropriately. And as I said before, in a year where your total super balance reduces, so there's negative earnings, you can carry that forward. So the losses, which we'll go through in a moment, can be carried forward towards future liabilities. Now, a key to this is that it's not a super fund liability, right? So this is, similar to Div 293 and old school surcharge. This is a liability on the individual. However, the individual can choose to pay it personally, or they can release it from their superannuation fund. So not too dissimilar to excess contributions, Div 293, all those sorts of things. So the final point that I want to make about the calculations is that effectively, because they are trying to just target the amounts above that $3 million, and they've brought in a couple of additional measures to say, if you're firstly, if you're under $3 million at the start and the finish, then you don't have to worry about this calculation. But if you are under $3 million at either the start or the finish, but not the other, then you effectively replace the under amount with the factor of $3 million there. So what they're trying to establish there is that under no sort of set of circumstances are you putting a factor of less than 3 million into the calculation to I guess overstate the earnings as such.
Yeah, so Tim, we've got that diagrammatically shown there. So you can see where you might move from a balance lower to a balance higher. We have to put a floor in essence in there at the $3 million, and then vice versa when the balance might go down. And there are a range of examples, like investment performance is one thing. Obviously, things like a credit of a reversionary pension will then impact that. Now, there is some potential things around death for both the primary member and the reversionary that have formed part of that discussion. We'll need to see where that ultimately lands in respect to how they might do it. I think, if I'm not mistaken, Tim, Treasury did say, though, if there's a loss, that loss will basically get lost with the deceased member. So there'll be no real carry forward around any loss that may be available for future use if it was going to a beneficiary or something to that extent.
Correct. And so I think part of the important thing is that, again, with those calculations, that if you undertake the first part of the calculation, which gets you to add back in the withdrawals and then subtract the contributions, if that first piece of the sum puts you below 3 million, so assuming that at the previous financial year, you were above it, if the first piece puts you below 3 million, then you just replace the entirety of that sum with 3 million. So you've always got to go through that first calculation first.
Yep, absolutely. So we've just got a quick question here. I might just throw this in because it's very pertinent. So Malcolm's asked, the view expressed is the industry funds would find it difficult to calculate a member's actual superannuation balance. Therefore, the more simple TSB has been adopted. I find this hard to understand. Surely an industry fund would know every member's actual account balance.
So, Malcolm, that is an outstanding question, and a question that was posed directly to Treasury and came back to us with well, let me put it this way, being mindful of the consultation process, was that Treasury said that there are some non-negotiables pre-consultation that government will look at, but whether or not they will actually make a change on that. And earnings is clearly and member balance is clearly the biggest one for us. So we know from the SMSF industry that, or the SMSF sector, should I say, that the capacity to identify members' total superannuation balance and the capacity to specifically allocate earnings to a member based on a fair and reasonable basis is a relatively straightforward process for us, and we do it via the member reports. So we feel that this is an area that the government has dropped the ball on from a calculation point of view, because we're thinking they're taking this simplistic approach to appease the APRA funds who currently don't do the level of reporting on the member statements that self-managed super funds do. So we feel, and I'm not going to steal Aaron's gnarly thunder that we're going to go through in a moment, but we feel that this is a classic measure where you should have the capacity to either determine absolute earnings, in which case you're then taxed on those earnings if you've got the accounting powers to do so. And should you not have that power, then at that point in time, you apply a formula-based approach. And we don't see any reason why Treasury can't have, or government can't have a two-pronged approach to the calculations.
Yeah, and that's 100% correct. And that's the view as an industry that we've put forward is you can't, whilst they're trying to say we need something that is uniform in its approach, the other measure in the budget, which I'll be talking about shortly, gives an approach that has two very distinct and different outcomes for APRA funds and SMSF. So how can you, on one hand, say something for one measure, but then not apply a same set of principles to another? And this goes right back to the Cooper review, right? When Jeremy Cooper, as the chair, said, SMSFs have their own unique set of circumstances. So there's nothing that can prevent or preclude us from drafting certain levels of policy that deal with the mechanics of the issues relevant to SMSFs. So there is here an opportunity to go, well, let's apply what we actually know, because we do actually know more about the members and their balances through the current SMSF reporting framework and what's captured in the annual return to what is in an APRA regulated fund. So therefore, I think we would appease 95% of people by actually getting to that approach by pulling out this whole unrealized piece. And then we would be able to move forward. And that's the debate, I guess, that we're trying to get resolved right now, and still naturally going pretty hard on the government to actually make that amendment. But, we will need to wait and see.
And just on that point, I think, Aaron, it's important to note that, we recognise here, and the industry has highlighted this, that I think 80% is the number. It might be slightly lower, but 80% of the people impacted by this measure are SMSF members, and so we should be taking the approach of what is best for the SMSF industry if they're the ones that are going to be the most heavily impacted, and if our accounting provides it, So Aaron, I'll get you to just sort of run through a quick example of the losses, just so we can sort of, I guess, tidy up the whole calculation piece.
Yeah, so and this was something that, Tim, I guess you and I initially raised when the fact sheets and the announcement came out, and then we did see some clarification in the consultation paper as well around the losses and the fact that it is a gross up base. It is a gross up process throughout each and every year. Okay, so we've got David here, 70. He's got an APRA regulated fund and an SMSF. So he's got 7 million across all of his benefits. He took out 400,000 and doesn't make any contributions into the fund. So his balance then at the end of the financial year is 6 million, which means when we look at that earnings calculation, we have $1 million of negative earnings, but then we have to add back our withdrawals. So we have a negative earnings for the purposes of the $3 million threshold represented at 600,000. And the representation of that we need to have as a loss carry forward is 50%. Of that proportion is above the $3 million. So we have $300,000 that is then carried forward and available for him to use and apply against future years. Now, that's just not the next year. It could be multiple years. And again, that's where we would probably see the ATO keeping track of this particular approach. And there was some money that was in the budget, about $47 million, that is going to be part of the cost of this measure, that naturally is going to be into things like developing the tools that the ATO need and for us to be able to track through MyGov and the like around this earnings loss. So we move forward a year, and at 30 June 2027, David's benefits have increased up to 6.5 million, and he's taken out $150,000 as benefit payments as well. So we've got 500,000 of earnings, and we need to add back the withdrawal on the assumptions that there's no contributions that have been made. So what we must first do, and this did become clear in the consultation, is we need to apply the losses against the gross earnings result for the year. So we take our 350 off our 650 here, that in essence gives us the remaining balance. And you can see then that the proportion calculation moves year on year on year. So it doesn't matter that the loss calculation had a proportion of 50, and therefore do we need to apply to 50? No, we look at it on a gross basis. And in this year, we now have a 53% proportion. And therefore we apply the 15% tax to the 350,000 by the 53% gives us our $27,800 odd of tax. And as Tim alluded to earlier, we then have the opportunity to pay that through the individual themselves, or there will be a release authority that will then come into play to enable that benefit to be deducted from the superannuation fund. And naturally, there's been a lot of conversations about liquidity. And I think it was very pointed, Tim, in the consultation paper as well, about the fact that they said trustees need to be aware of their obligations under their investment strategy. So, liquidity, meeting obligations as and when they fall due. That wasn't clearly directed to APRA fund trustees. I think that had a very deliberate message at SMSF trustees. So most importantly then, I guess, what have we learnt since then and the current state of play post-consultation about a number of issues that have been flagged?
And look, I think this is, I'm going to reverse the order of some of these dot points, given that we just had that great little example of the carried forward losses. So what the consultancy period did certainly highlight to me was that, when you die, so do your losses. So whilst your spouse might get the benefit of a pension and therefore the benefit of going over $3 million post your death, they're not going to get the benefit of any losses that you had previously had attributable. So everything dies with the member, except for the credit to the spouse in the future. So the whole concept of carried forward losses is based exclusively on the individual. Now, there's an additional sort of important point there, and it's all linked to this concept of death benefits. And, we often sort of, I guess, approach this with a lighthearted approach when we're talking through pension strategies and when members die and whatever with regards to minimum pension obligations and other things. If you die during the year and your benefit is not paid out, so your member balance is still sitting in your interest at the end of the year and your total super balance is over that $3 million at the end of the year before the benefit is paid, then there will be no assessment based on that year of death. So basically, any liability for this tax will die with your death. However, again, subject to the conversation we had with Treasury, if you die on the 1st of July, then your balance at the 30th of June, you're still alive. And so there would be a tax liability calculated for that year, which would then be subject to being paid out via the estate. So, these are little quirky elements that really aren't addressed properly through the consultation process, and hopefully will be addressed via the final legislative piece that we see, because there's certainly some inequity, particularly around death. But that leads to the broader conversation piece where we can start to introduce some other concepts around insurance proceeds and other things. And that is around the concept of debits and credits. So we're almost talking transfer balance cap again from a conceptual point of view, but what we're talking now is debits and credits in the sense of withdrawals and contributions. And so things like a reversionary pension will be considered a contribution to the spouse. And so in the first year, they will subtract the value of the reversionary pension from their total superannuation balance. So they effectively get a 1-year grace in regards to the $3 million cap. But of course, the following year it's going to be counted. So, it just creates this, again, inequity in the sense that from a total super balance point of view, so for contributions, the pension counts as soon as it's allocated to you. From a transfer balance cap, it allocates in 12 months' time. And from a tax concession point of view, it could be 12 months plus. So, different rules for different measures, and that can create issues. Similarly, insurance proceeds, they will be treated like a contribution. So there will be a negative or a subtraction of the insurance proceeds in the first year. However, that leads to this conundrum in the sense that a TPD payout, for example, will be a negative amount in year one, but then it will count towards a member's total superannuation balance, versus personal injury and structured settlement contributions, where they don't count towards a member's total superannuation balance, so they are ultimately excluded from this concept. And so this creates this huge inequity that a person under a same injury or illness condition, subject to the source of the proceeds, will either be included in this measure or excluded from the measure. And that's not a just outcome, where somebody, particularly someone who is nowhere near retirement age, has the insurance proceeds, comes in and needs to have, or is in receipt of a disability superannuation pension, to then potentially also be levied with an additional 15% tax because of that money that's to provide for their early retirement ultimately, versus getting a structured settlement payment. So, there's a lot of areas there that as an industry, we have to play hard on, or we have to go as hard as we can, because things such as TPD have always been a problem since the introduction of the transfer balance cap and the total superannuation balance rules. So, that's one to be mindful of. Now, I'm not sure whether or not, I noticed that there are a few questions coming through. I'm not sure if there's any specific to that.
We might just leave those towards the end, given time. So we'll keep pushing through, and then we will hang online and we'll answer all the questions. We might even run a Q&A podcast or something as well, for those that can't hang around too.
No, that's fine. So then if I jump in and talk a little bit again, very quickly about a couple of these things like family law splits. So if you are splitting your super under family law provisions, then that will count as a contribution to the receiving, so to the non-member spouse, and it will count as a withdrawal to the member spouse. And again, here's the inequity. If under relationship breakdown, your money leaves you and goes to your spouse, you could still end up with a tax liability by adding that withdrawal back in to the fund. So there is a lot still to unpack in regards to this space. And these were a lot of the comments where Treasury was saying, we'll take that to government and see what they say, which, again, time will tell. Again, linking back potentially to issues like permanent capacity, but the inclusion on certain limited recourse borrowing arrangements that can create inequity, as does the use of reserves. And I've deliberately jumped over legacy pensions there because we know that reserves are largely legacy issues from a self-managed super fund point of view, and their greatest legacy is linked to legacy pensions. Now, our lifetime and fixed term pensions, without giving away too much about the slides coming up in a moment, but clearly legacy pensions inside self-managed super funds haven't been contemplated, because how they measure up against total superannuation balance is actually, again, an area of concern. So what we are asking Treasury to talk about here, or to talk about with government, is we've got other measures that are far more important that they look at finalising before they finalise the piece on this potential tax liability and what our members' total super balance is.
Yep. Yeah, so I think the quick one there with the LRBAs, of course, just to note, is that it does add back from any post 1 July 18 for related party, and correct, where someone has met a condition of release that has a nil cashing condition. So again, there are people that might get caught up in it because they turn age 65. Or through the fact that it's a related party loan as opposed to a bank product around a limited recourse borrowing arrangement.
Well, yeah, but also, and just to jump back too, you take that person that has had a TPD event and they've got an LRBA in their fund. So not only will they get the insurance proceeds counted, but then they'll also get the value of the loan added or proportionally added back to their total super balance as well. And it's crazy. Yeah.
Yeah. So there's, I guess the short answer is there's still a lot of water to go under the bridge.
Correct.
So we've got a number of questions. As I said before, we will come back at the end. We want to make sure we get through what we have promised to get through throughout this session. So the other key measure that we saw announced in the budget was around a finalised position in respect to the non-arm's length expenditure rules. And they NALI sit within the NALI provisions. So that is if you have a non-arm's length expense, then it will invoke the non-arm's length income provisions. So one of the things that we saw earlier this year was a consultation come out looking to address the concerns that had been raised over the past couple of years about the disproportionate outcomes from the Commissioner's views in Law Companion Ruling 2021/2. And that is specifically in respect to the general expenses provision. So what the government had initially proposed was a 5 times factor to dealing with non-commercial expenditure that would have triggered the non-arm's length income provisions. So in the budget, they have now said, well, we are not going to apply a 5 times factor, but we are going to continue with this factor-based approach. That ultimately means rather than a multiple of 5, we're going to be looking at a multiple of 2x, i.e. 90%, rather than 225%. So the fund's taxable income will then, the fund's income will be taxed as NALI, but most importantly, it will exclude contributions from that calculation. So we got some clarification there. But what is somewhat perplexing, and it's consistent with what they'd mentioned in the initial consultation, is that we have a different set of rules for APRA-regulated funds than we do for self-managed super funds. So here is where the issue is that Tim was touching on earlier, that the Treasury, with government, have in essence said, let's set up a different playing field here for APRA and SMSFs, but we must have a consistent approach in the better targeted superannuation concessions. So that to me is staggering, given that we've had, I think it goes back to 2016, Tim, there was one of the first times we had a draft ruling before the laws were actually finalised. So it's greater than 5 years. We've had countless associations, legal, accounting, SMSF, APRA funds working as a collective to try and get resolution on this. This discussion was, this approach was never really raised, yet here we are, that we've got a finalisation into this factor-based approach. So we have an exemption of APRA-regulated funds, which the issue was actually arguably much bigger in APRA-regulated funds, but the government has said, well, we see the potential here for abuse in SMSF land than we do in APRA-regulated funds. And Tim, you've kind of given examples before, I guess, in APRA-regulated land that just kind of opens up the opportunities, doesn't it, to carry on as they've always done.
Yeah. And look, the webinar only goes for a certain length today, Aaron. So you know, we should make sure that we don't get too firmly on that soapbox. But yeah. So I guess the most important thing to note here is what we need to do is we need to look at the shortfall between the amount that was charged or what should have been charged. And what was charged can include zero. And then from there, we are applying a 2 times factor to determine the amount of income that would be subject to NALI. And as I touched on before, we exclude contributions. So what I've done here is this was an example that was incorporated in the consultation. And what we've now done is we've recut this based upon what the budget outcomes are. And this is really relevant, I suspect, for a very large majority of practitioners with their SMSFs, where they may be utilising the services of their firm, which includes software and so forth, and they may not be charging a fee. Now, we're parking a whole range of other aspects within Law Companion Ruling 2021/2 that may be relevant, things like how policies for discounts and so sort of things apply. But let's work through this example to help you understand the issue a bit further. So we've got an SMSF is using that brother's accounting services, and commercially, the fee to undertake that work would be $5,000. His brother, because it's his brother, does not charge anything for those services. So we have ourselves a non-commercial arrangement. Now, for the financial year within that self-managed super fund, we have $100,000 of assessable income that would ordinarily be taxed. And we're going to assume that we've got $15,000
of concessional contributions here as well. So under the current NALI rules, what we have is general expenses of the fund that can be sufficiently connected to all of the fund's income. And therefore, the rules as it applied now would tax all of that fund's income as NALI and then be subject to the 45% tax rate. Now, at the moment, we have our PCG 2020/5, which is the Commissioner's current guidance that says we're not applying compliance resources to any of these activities between 2018 to 30 June 2023. The ATO has made very clear that they do not intend on extending this beyond 30 June 2023. So under the proposed amendments here, the income tainted would be limited by the market value of the accounting service since no fee was charged. And then we're applying this factor of 2 to determine the difference on that shortfall. So here the trustee would pay tax at a rate of 45% on $10,000, being 2 times the $5,000 shortfall. And then on the remaining $90,000, we would have a concessional rate of tax that applies to superannuation funds. So we'd have $18,000 in tax that would be attributable, rather than previously we had a much higher rate at a factor of 5. By comparison, if the $5,000 of accounting fees was actually paid, we would have $14,250 in tax, being the $95,000 of taxable income, naturally applying off the $5,000 deduction for the accounting fees multiplied by that particular rate. So the issue comes, or the complexity comes, where we have very low levels of investment income inside the SMSF. And this is where it starts to get trickier, because as we work through a number of these examples, you could determine with a factor of 5 that you could get these alternate scenarios. But with a factor of 2, you actually need a very low level of income to have to fall back to a position of the current rules. Because when we look at the calculation here, we need to apply whether the current rules provide the best result, i.e. the lesser amount of tax, or do we apply the factor of 2 result? And you need to go through and do that with each of the various examples that you'd have in your client base. So if we apply the exact same rationale here, where we would have a $5,000 shortfall in the accounting fees, but we only have $20,000 of income, and that assessable income included $15,000 of concessional contributions. So in that instance, we've only got $5,000 of, say, dividend income, interest income, whatever the case may be. So under the amendments, because Treasury have confirmed that the factor approach from 5 to 2 is really the only change they are intending to make from the issues raised in the consultation, or the proposed approach in the consultation, is we need to work out the lesser of those 2 approaches. So we either say we've got a 2 times factor on our 5,000 multiplied by the 45%, which gives us $4,500 in tax, or we say, well, what is the actual income of the fund? Obviously excluding our concessional contributions, which is 20,000 minus 15,000, which gives us $5,000 of income. Multiply that by 45%, and that gives us $2,250. So the second result is a better result than the 2 times factor. So therefore, under the consultation, you could actually apply that result rather than the 2-factor approach. Now, if the income was $10,000 here, well, then what we found out was that the 2 times factor approach then was a better result and then naturally moved up. So low levels of income and significantly lower levels of income may result in an alternate approach being the existing set of rules. So here you can see that the SMSF would be required to pay $4,500 in tax versus up to $6,250 if it was under item 1, being the 4.5 plus the contributions tax, whereas under item 2, they pay the $2,250 plus the contributions tax, which takes us to $4,500. So the ATO has previously made clear through the LCR 2021/2, and the government has confirmed within that consultation paper as well, that this change is only related to the general expenses and the nexus that has to the fund's entire income. This does not relate to specific assets with a specific nexus to, say, property agent fees that relate to property. Those arrangements are NALI, that apply the NALI provisions from the 1st of July 2018. So I guess the question here then becomes, again, there is a lack of fairness here in respect to APRA-regulated funds, in essence, are exempted from this entire issue, whereas SMSFs are subject to this factor-based approach. The view is that SMSFs, due to the member and trustee hats that they wear, there is a greater tax integrity risk to influence the outcome of that arrangement. So the argument really that has been put forward for some time is, have we made a mountain out of a molehill? And by that, the genesis of this goes way back to when we were talking about zero interest loans. And the fact that we then saw a response by the ATO to comply with a safe harbour provision for LRBAs in PCG 2016-5 meant that that issue was then dead and buried. Now, there are a number of things that also we can see that kind of are unresolved still around the application of this. And there's cases where we look at Trang in the issue. So she was a plumber, I think, from memory, Tim, and the fact that we could simply apply the contribution rules. What is a contribution? And what we see in tax ruling 2010/1 really highlights the fact that where we see those personal exertion shifting value across the SMSF, well, that sort of stuff can get captured into the definition of a contribution. And if they're excluding APRA funds from this, well, why don't we maybe, rather than looking at how we've got it structured within our div in our section 295/550 around NALI, why don't we actually incorporate this back into the SIS regs and in the SIS Act, more specifically into our arm's length dealings, which therefore brings it into the scope of the annual audit process, and we can assess based upon materiality and so forth. So if there is a more targeted issue and concern around self-managed super funds, then bring it into the audit program and allow it to be tested that way. So I think it's not the outcome that we would have probably liked. It's somewhat of a win because we've peeled that back from 5 to 2. Tim, I don't know if you want to add anything else to that before we sort of move on to our next topic.
Look, I think that probably the main thing that I would add is the link. The general expense is obviously a thing that's dear to many of us because we operate in the accounting and administration space for self-managed superannuation funds. But I really think that the fact that TR 2010/1 is now back in draft format rather than finalisation format and has ultimately been now for 6 years. So, the fact that as an industry, we were pretty comfortable with what is and what isn't a contribution, and the ability to offset expenses and the like with contributions just creates a whole heap of confusion to a space where most of us thought it was all settled and done. So, I do have a lot of concerns about the specific nature of transactions, and I hope that we can get resolution on that. But I don't necessarily hold my breath.
So let's move over, Tim, then to, I guess, what else is worth noting. Some of this was not necessarily in there, or we can read between the lines, I guess, around it. And the first thing I might touch on, Tim, is just we did see this payday super concept get introduced into the budget, where from the 1st of July 2026, we're going to have alignment with wages and superannuation. I would presume there's going to be some sort of carve-outs like there is for SuperStream for related party type transactions. But again, the devil will be in the detail there. And maybe, Tim, do you want to touch on those other couple of issues here?
Yeah, so look, I mean, obviously the one that no announcement means means moving away from the current status quo, and that is the 50% temporary minimum reduction. So, last year and the year before that, we had the minimum pension reduction, and each year in budget there would be an announcement to say that we will maintain the 50% reduction. So this time we haven't seen that. So we know that unless, as part of our theoretical mini super budget, unless there's any further announcements, that we return to the normal payment percentages or payment factors for both account-based pensions and market-linked pensions. So from 1 July, we need to do recalculations. And then the other key point, which I think we're all grateful for, is that we didn't hear any announcement with regards to any freezing of the general transfer balance cap. So, you know, we can move forward from a strategic point of view with planning for contributions and other things based on a total super balance of 1.9 million versus the current 1.7 into the new year. So again, you know, it was a fear factor that we hoped against any changes, and we clearly haven't seen any. So that's a positive for the industry.
Yeah, and I think with the minimum pension stuff, yeah, the reality is we probably got one more year than what we thought. You know, the fortunate thing was there was an election, and both of them were committed. We won't probably therefore see the phase out that we did see through the GFC, where it went from 50 back to 25. But it is worth noting that can be done fairly quickly, because it only needs to be done through a change to the regulation, which actually doesn't need to go through both houses for that change to take effect. So we did see that with the coalition a few years ago from memory, that they sort of did that on the death knell of 30 June 1 year. So I guess just watch that space. But our view is that it will probably renormalize itself again. So what wasn't announced that I guess we would like to get some closure on is probably the right word, Tim, because these were previously announced budget measures. And yes, with our residency, we saw a little bit of info issued in Budget 2.0 last year, but our legacy pensions, we haven't. So I'll get you to sort of touch on that a little bit further.
Yeah, so very, very quickly on the residency, and you may have seen my comments in our blog, and that is that the residency changes really seem to have universal support. And that is the removal of the active member test and the extension of the central management control temporary absent from 2 years to 5. And so it would seem that it's not one that requires a great deal of consultation. So it really is just a draft release and move on. So hopefully maybe we see something before 30 June, but if not, let's expect a 24 announcement, so from 1 July 2024.
And that's an important, I was just going to say, Tim, that's a really important point, because what they did change last year in the federal budget, the second one is because it was intended to start from the 1st of July 2022. We didn't see anything. So they said, well, it will start from the year following royal assent being received. So if we don't see anything this financial year, then as you rightly said, we're not going to see it take effect any earlier than 1 July 2024.
Yeah, and that becomes a nuisance factor largely for the active member test rather than the central management and control to consider there. But the legacy pension conversion one, now there was obviously a lot of issue associated with this, with the potential tax liabilities and things attached to it. But I think probably it now becomes far more relevant because, and part of our Treasury consultation is how are we going to count these pensions from a total super balance point of view, given that they are largely represented as reserves. But secondly, if there are significant legacy pensions still in existence, which the short answer to that is there are, then giving people the capacity to rip them out of the super system then alleviates that higher tax liability in the future. So, you know, really to move ahead with the better tax concession or the better super concession measure, they really need to finalise this legacy pension conversion so we at least know where we stand with regards to how the reserves will be treated and the capacity to withdraw it. So, yeah, it's a measure that we pushed hard with Treasury to get on top of so that we can move forward with some ounce of comfort as to where we sit.
Yep. And I guess we finish at where we started because what we started with was, of course, this framing of the objective of super. And therefore, when we think about this being resolved, whether it's a separate piece of legislation, whether it's brought into the SIS Act and SIS regulations, what they have made clear, and they've been very deliberate in some of the commentary that they've had around this, is it does mean that there are further changes that will occur. So we don't know when they will occur. We don't know whether they'll form part of budget, whether they'll maybe put some stuff out for consultation once they've actually, I guess, locked this objective away. But one area that they've been very clear on is the concept of preserving savings for retirement. So that means that they want to ensure that it is there for the benefit to pay members during their retirement, and then is consistent with the core and ancillary purposes of superannuation. So things like early access under compassionate grounds, where we know there is ready access to money for certain elective surgeries, and we know there are promoter schemes out there as well. This is something that Minister Stephen Jones has actually spoken about and raised, and they do intend on tightening that up. And Tim, I might get you to touch on the first Home Saver Super Scheme, because we did see the coalition government obviously look at the concept of utilising housing as a measure, which is certainly at the polar opposite end when it comes to the Labor Party.
Yeah, and so again, without sort of speaking about what we don't know, you know, the whole idea of using superannuation for the purposes, or using the contribution scheme to make contributions to preserve them until a point where we wish to sort of call on those to purchase our first home, you know, that generally leads us well away from this concept of the objective of super. So, you know, does that mean that the first home super saver scheme has a limited shelf life, and people that are engaging in that at the moment really need to be mindful that it may not be a policy that sticks around for too much longer. And then if it is abolished, will there be grandfathering provisions and things brought in? So you know, it just creates this whole lot of uncertainty around these measures. Yep.
I think the other thing there's some validation to be nervous a little bit around is our LRBAs, and we got our Council of Financial Regulators report that did tap into, whilst there's no systemic risk to the sector more broadly around the use of leverage in super, there are still pockets of concern, even though we've gone through some fairly substantial changes over the past 3-4 years with banks moving, ASIC's greater focus around the provision of advice, and so forth. So we just kind of flag that as a potential area, and recontribution strategies. I guess one of the other areas that they talk about in delivering income for retirement with the objective of super is making sure that it's not there for estate planning purposes. And I know, Tim, we kind of had a bit of a discussion around this, because I think it was the Grattan Institute that did highlight this in a submission that they made to say, well, you know, the recontribution strategy, whilst I think in the current law, you know, you'd struggle to apply Part 4A to it, but maybe you need a mechanism to not allow people to be able to, in essence, undertake multiple recontribution strategies that would naturally provide a longer-term estate planning benefit if that was the resultant outcome.
Yeah, and you know, where does the $3 million cap come in with recontribution strategies as well? So it's a little bit of clickbait at the moment, but I think it's certainly something worth monitoring.
Yep. So I guess as we wrap up, with a couple of slides here to go, but the few things here for me is it is important you just wait for the detail on the budget measures, and that's why people like Tim and myself are here to obviously help go through, understand, listen to the dialogue. So, you know, someone like Tim, as front and center today, was able to share with you some insights from where Treasury is at, and then where we as an industry would like to go to as well. That means that, yes, we need to be cognizant of these issues, and we need to stay up to date with these issues as well, and be aware, therefore, that when these things then start to play out and they get resolution, the landscape then will look to change, and you need to respond to it. And that not only occurs with the things that we've spoken about today, but it also comes with things like the objective of super into the future. And Tim, I guess the last one here is just getting the identification process underway. So whilst we're waiting for the devil in the detail, it doesn't say we just sit and wait to see what then ultimately happens. We need to start identifying circumstances, and this might include your own, on key measures as well.
Absolutely. You know, should you be reviewing your accounting fees? Should you be be reviewing your policies for staff discounts, all those sorts of things? I mean, the short answer to that is yes, but also reviewing your pension obligations in light of the fact that the minimums have been lower for the last 4 or 5 years. So time to act is now.
Yep. And that leads us on, I guess, to our next event, which is our SMSF tax planning webinar. So Tim, you and I, we have a 1.5 hour session. So for those of you today that would like to attend, we have got a coupon code in there. It's normally $220. So if you apply the code, you'll get it for $176. So it's not only the 1.5 hour webinar, but we do have a 35+ page. I don't know what it's up to now, Tim, but you're kind of doing a fairly comprehensive review on it at the moment. And it provides you with all the tips, traps, and strategy considerations with contributions, pensions, around the investment rules, and so forth, to help you look at and implement with your clients in the lead up to 30 June. And one final incentive to help us to get more information through our survey is that if you complete our survey, you'll go into the draw to win one of 5 complimentary registrations to that event. So we will be announcing those winners. We'll get in contact with you by email or phone by close of business tomorrow. So you will get that email, you'll get that survey link, I should say, after today's event, and then in the follow-up email as well. So that's it. Tim, thank you for being a part of today's session, gave some valuable insights. Just a quick note there of our upcoming events, not only our tax planning, but our changing face. We are running an integrations week as well in the middle of June to highlight the integrations that we have right across our BGL, Class, Supermate, and with the government agencies to incorporate companies to do your ABN and TFN. So be on the lookout for some of that in our next newsletter as well. So that is it. I will now look at answering, Tim, we might go off for those that need to leave, but we'll look at answering a whole range of other questions. Like I said, if you can't hang around, we will look at creating a Q&A podcast of those as well. So thank you once again for joining us. And we look forward to catching up with you at an event in the near future.